doing a 25% tariff.
Unjust U.S. tariffs.
And that higher tariffs on trading partners.
It's not Liberation Day. It was called Termination Day.
What if I told you America's biggest trading neighbor, Canada, just made a shocking move? Instead of dealing with U.S. companies, Canada signed fresh trade agreements with 11 other countries, leaving some of America's biggest left behind. American companies once believed Canada would always remain their safest and most reliable partner. But overnight, that belief has crumbled in an instant. The result? A wave of disruption that is shaking the very foundations of U.S. trade. In today's countdown, we're looking at 7 American giants now facing the heat. From auto parts to retail, energy to finance, these brands built empires on Canadian trade. But with Canada pivoting to new partners like Japan, South Korea, Australia, and Brazil, those empires are starting to crack. The retail titan, losing its northern grip. Walk into any U.S.-Canada border town, and you'll see giant warehouses stretching for miles. Conveyor belts buzz with activity, trucks line up like dominoes, and thousands of jobs depend on one thing: American goods flowing north. One retail titan in particular made Canada its crown jewel, raking in nearly $1 billion a year in revenue from Canadian consumers. But now, Canada's new deals flip the script. Electronics from South Korea, home goods from Japan, and even food products from Australia can now reach Canadian shelves directly, without touching U.S. warehouses. That means the middleman role American retailers once dominated is disappearing fast. Before we continue, make sure to hit the like and subscribe button. It really helps us to update you daily. The numbers paint a chilling picture. Leaked memos show a 23% projected drop in Canadian sales. For this company, layoff plans are quietly being drafted for thousands of border facility workers. And just hours after Canada announced its new trade partners, the company's stock dropped nearly 8%. The bigger problem? Supply chains aren't like switches you can just flip. When a company builds dozens of massive warehouses and trains thousands of employees specifically for one market, those assets don't easily shift elsewhere. They become anchors, weighing the company down while faster, cheaper competitors race ahead. Wall Street analysts already call this the beginning of a retail realignment. But for workers on the ground, it's not just numbers. It's their paychecks, their mortgages, their futures. So, is this the end of American retail dominance in Canada? Or just the start of a bigger trade battle that could reshape North America's shopping landscape forever? The auto parts giant, facing gridlock. For decades, the heartbeat of Detroit echoed across the border into Canada. Assembly lines roared, parts moved seamlessly, and the U.S. and Canada became one giant factory floor. At the center of it all was a legendary American auto parts manufacturer, a company whose components kept Canadian cars rolling, from brakes to engines to transmissions. Every year, this giant pulled in over $1.2 billion in Canadian sales. Their supply chain was so finely tuned that a bolt made in Michigan could cross the border in the morning, be installed in an Ontario plant by afternoon, and return south as part of a finished vehicle by nightfall. It was a dance of precision, until now. Canada's new partnerships threw open the doors to South Korea and Japan, two global auto powerhouses. Both nations already produce high-quality parts at competitive prices. Now, with preferential trade status, Canadian automakers suddenly have access to cheaper, faster alternatives. Why pay more for U.S. parts slowed by tariffs and red tape when they can source directly from Asia? The math doesn't lie. Canadian factories can now save up to 15% on certain components by skipping U.S. suppliers. In a hyper-competitive industry where margins are razor-thin, those savings aren't just tempting, they're game-changing. But the problem for this American auto titan runs deeper. Their business model wasn't just about selling to Canada. It was about integration. Factories, workers, and suppliers across the Midwest were tied into Canadian production like gears in a single machine. Now, that integration has turned into a weak spot. Industry whispers already point to Korean manufacturers scouting Canadian plants for joint ventures. Japanese executives are touring Ontario facilities, considering direct partnerships. Meanwhile, American factories that once thrived on Canadian demand are staring at shrinking order books. The company's CEO recently called an emergency board meeting. The agenda had just one chilling line item: strategic response to Canadian market disruption. For workers on the floor, it translates to one word: uncertainty. Is this just a temporary setback in a trade scuffle? Or are we witnessing the beginning of a massive reshuffling of North America's auto supply chain, one that leaves U.S. firms stalled on the side of the road while their Asian competitors speed ahead? The agricultural giant, watching harvest slip away. Amber waves of grain, endless rows of corn, and soybeans stretching to the horizon. That's the backbone of American farming. For decades, much of that harvest flowed north into Canada, where one U.S. agricultural giant dominated the trade. From wheat to processed foods, the company controlled nearly a third of Canada's agricultural imports, generating billions in sales. But today, the landscape is shifting like sand in the wind. Canada's new partnerships include Australia and Brazil, two of the biggest agricultural exporters on the planet. Both nations bring exactly what Canada needs: grain, soybeans, and food products that compete directly with U.S. farmers. And now, they're coming in with tariff advantages the U.S. no longer enjoys. The numbers hit hard. Australian wheat can now enter Canadian markets with a yapais 12% price advantage. Brazilian soybeans, once costly to move north, are now fast-tracked with expedited processing rules. That means Canadian buyers can get the same goods cheaper, faster, and without relying on American suppliers. The fallout ripples far beyond trade charts. This agricultural giant built massive grain elevators, processing plants, and transport networks designed specifically for Canadian demand. These facilities rely on volume. Without it, they bleed money. Already, rural towns in North Dakota, Montana, and Minnesota are bracing for impact. Farmers who once depended on Canadian contracts are watching commodity prices slide. Local economies that grew around agricultural jobs now face a dangerous squeeze. The company's quarterly report quietly slipped in a warning. Anticipated volume reductions in Canadian markets may necessitate facility consolidation. Translation: plant closures, job cuts, communities hollowed out. And here's the kicker: agriculture isn't just about economics, it's about survival. When America's northern breadbasket loses its biggest buyer, the effects hit family farms first. Fewer sales mean shrinking incomes, tighter budgets, and tough choices for the next generation. Do they stay and fight a losing battle, or abandon farming altogether? Some analysts are already calling this the start of a modern dust bowl. Not from drought, but from diplomatic drought. The kind where farmers don't lose crops to nature, but to politics. So, will American agriculture reinvent itself to survive? Or will these new partnerships starve U.S. farming communities of the lifeline they've counted on for generations? The Energy Corporation, losing its northern lifeline. Pipelines stretching across prairies, refineries blazing like small cities, and tankers carrying fuel that powers millions of homes. That's the image of U.S. energy dominance. For one massive American energy corporation, Canada wasn't just a customer, it was a lifeline. Their partnership brought in over $3.4 billion annually. Built on a simple equation: Canada supplied the crude, America refined and distributed it. For years, it was a perfect marriage. But now, Canada's new trade web threatens to unravel it. Nations like Norway and the United Kingdom bring advanced energy technologies and global distribution networks. Meanwhile, Australia swooped in with something American firms never offered: partnership instead of dependency. Here's what that means. Instead of shipping raw resources south to U.S. refineries, Australian investors are helping Canada build its own refineries and processing plants. That keeps more profits in Canada, while still giving them access to booming Asian energy markets. Suddenly, America isn't the essential middleman anymore. It's just another option. The numbers are brutal. Internal company projections show Canadian crude access could shrink by 34% within 18 months. Pipeline revenue is falling, refinery utilization is dipping below profitable levels, and emergency restructuring is already on the table. Stock prices for the corporation have slipped 15% since the announcement of Canada's new deals. But beyond dollars, this shift hits America's broader energy strategy. For decades, politicians sold the idea of energy independence. Yet in reality, much of that independence leaned on Canada's resources flowing south. If that flow slows, or worse, reroutes, America's energy dominance starts to crack. And while this U.S. corporation scrambles, Canadian officials are smiling. With new refineries, they keep jobs at home. With new partners, they gain leverage in negotiations. With new routes, they reduce dependence on American pipelines. One analyst summed it up bluntly. This isn't just lost revenue. It's a restructuring of North American energy. So the question looms. Can American energy giants adapt to a world where Canada is no longer a captive partner, but a free player on the global stage? Or will they find themselves left behind, watching pipelines run dry while competitors fuel the future? The technology firm losing its data. Highway. In today's world, oil may power engines, but data powers everything else. From online banking to hospital records, from government security to your favorite apps, one American tech giant built its empire on controlling the flow of data across North America. And for 2 decades, Canada's information superhighway ran straight through its US-based networks. The scale was enormous. This company handled over 800 million daily transactions from Canadian institutions. Its 12 Canadian data centers employed thousands and generated nearly $2 billion annually. The message was clear. If Canadian data wanted to connect to the world, it had to pass through American infrastructure. But now, that advantage is fading, fast. With new trade partners, Canada is building alternative digital highways. Singapore and South Korea are stepping in with lightning-fast data processing systems. Switzerland is offering gold-standard banking security. The United Kingdom is bringing advanced artificial intelligence collaboration. Suddenly, Canadian data doesn't need to pass through the US at all. It can route directly to Asia or Europe. The bombshell came in a little-noticed announcement. Canada is laying new trans-Pacific data cables. That bypass American servers entirely. What once took a detour through US hubs will now flow straight across the ocean. For the American firm, this is more than competition. It's erasure from the map. Internal reports already project a 28% drop in US network usage as Canada shifts traffic elsewhere. And once those cables are in place, the decline could accelerate. The company's stock reflects the panic, swinging wildly day by day as investors struggle to price a future where half of North America's data may no longer pass through US hands. The deeper problem? This company didn't just rely on data volume, it relied on Canadian dependency. Research partnerships, hiring strategies, and billion-dollar facilities were all built on the assumption that Canada needed US networks. Now, Canadian banks are exploring direct links to Swiss financial systems, universities are partnering with Japanese AI labs, and government agencies are testing secure storage solutions that exclude American firms altogether. Analysts are calling it the decoupling of North American digital infrastructure. And for this once mighty US tech firm, the question is chilling. How do you rebuild a digital empire when your neighbor builds its own road that drives right past you? The manufacturing conglomerate. Watching assembly lines go dark. For decades, America's factories and steel plants powered not just the US, but all of North America. At the center was a huge US manufacturing conglomerate, earning nearly more $2.7 billion a year or spree from Canadian sales. This wasn't just exporting products, it was MAR integration. US plants made raw materials, Canada specialized in precision parts, and together they kept industries running, but Canada's new trade deals are tearing that system apart. Countries like Japan, South Korea, and Australia now offer machinery that sometimes outperforms American tools. Canadian factories suddenly have choices that leave U.S. suppliers out. The sting runs deeper. U.S. and Canadian plants once depended on each other. Now, German and Japanese firms are offering to make Canadian sites fully independent. Entire assembly lines could shift away, leaving American workers with silent machines. Analysts warn of an unraveling industrial North America. If Canada cuts the cord, thousands of U.S. jobs may vanish in months, not years. The financial services giant, losing its northern vaults, towering glass offices, trading floors buzzing with deals. This is America's financial services giant, long the backbone of North American money flows. Its Canadian branch alone pulled in $4 billion annually, handling everything from banking to global currency exchange. For decades, Canadian businesses needed U.S. banks to reach world markets. Not anymore. Canada's new trade ties bring in Switzerland, Singapore, and the UK. Financial powerhouses with direct access to Europe and Asia. Suddenly, Canadian corporations don't need Wall Street as their bridge. The shift is already visible. Canadian miners trade in London. Energy firms raise funds in Asia. Pension funds look to Australian partners, while insurers test European systems. For the U.S. giant, nearly a quarter of international revenue is at risk. Internal reports show client losses and falling exchange volumes. Analysts call it the balkanization of North American finance. Without Canada, Wall Street's northern vaults may soon sit empty. The cascading crisis. When dominoes fall. Together, think of North America as a circuit board. Each glowing line a trade route, each hub a community. For decades, power flowed smoothly between the U.S. and Canada. Now the lights are flickering. This isn't just about lost contracts. When a retail warehouse closes, drivers lose jobs, gas stations lose business, diners lose their customers. When auto parts orders vanish, steelmakers, rubber plants, and electronic suppliers all suffer. Economists call it the multiplier effect. Every lost Canadian dollar cuts $2.40 from the U.S. economy. The fallout spreads to border towns like Buffalo and Grand Forks. Their banks, logistics firms, and workers once specialized in Canadian trade. Now, those skills and businesses risk becoming useless. The dominoes are falling one by one. The only question? How many more before the U.S. can stop the chain reaction? The geopolitical chessboard. Who really benefits from America's loss? Zoom out from the trade numbers. Imagine a global chessboard. The U.S. on one side, rising powers on the other. In the middle, Canada, America's closest ally, making a move that reshapes the game. Canada's 11 new partners each bring something America once controlled. Australia covers agriculture. Japan and South Korea deliver auto parts and tech. Norway and the UK strengthen energy. Brazil and India supply food and IT. It's not just variety, it's insulation from U.S. power. But the real winners may be watching quietly. China benefits as North America's unity cracks. Russia sees energy networks fracture. Even Europe could exploit the gaps. And remember, economic ties shape military ones. If trade pulls apart, alliances like NATO could weaken too. Experts warn this is the birth of a mesh network economy, where nations trade directly, leaving America optional. The question is, if even Canada can live without the U.S., who's next? The clock is ticking. Every collapse follows a timeline. First it creeps in, then it accelerates. That's what's happening to U.S.-Canada trade. It started in January 2025, when Canada revealed its new 11-nation deal. At first, Wall Street shrugged. Canadian buyers began shifting orders. U.S. firms brushed it off as temporary. But by June, the hit was clear. Canadian demand for Australian mining equipment jumped 340%, while U.S. exports fell 20%. Contracts vanished overnight. By 1 September, Canadian factories restructured supply chains. Parts once crossing Michigan now came from Asia. U.S. suppliers lost $847 million in 3 months. By December, Canadian energy imports from Norway soared 67%, while U.S. sales hit their lowest since the 1980s. The speed is shocking. Economists warn once Canadian firms find cheaper, faster partners, ties to the U.S. collapse instantly. The clock isn't just ticking, it's racing. Can America adapt before the final buzzer? We've just seen how 7 U.S. giants, from retail to finance, energy to tech, are being shaken by Canada's pivot to new trade partners. What does this mean for the future of American power? Could this be the beginning of a permanent realignment, or is there still time to recover? What do you think? Can America rebuild its dominance, or has the tide already turned? Drop your thoughts in the comments. Don't forget to like, share, and subscribe, so you never miss the big stories shaping our world.